What's up, guys, and happy new year. And in this video, what I'm going to do is I'm going to show you sort of like what the market looked like in 4 interesting charts that were published on the Wall Street Journal. And in the second half of this video, I'm going to walk you guys through sort of like how I filter and look for and find opportunities, and then ultimately value opportunities that I present to you guys on this channel. And so as you guys smash that like button, let me run that intro. What's up, guys, and welcome back to the channel. And as we get into 2023, there were some really interesting charts that were summarized by the Wall Street Journal that sort of showed us visually what the 2022 stock market looked like. And so here's the first chart. So you can see, when it comes down to the indices that declined the most, I think this chart tells an interesting story because, I always talk about the S&P 500, and the reason why I generally talk about the S&P 500 more than any other index is because I generally invest in a diversified array of securities. And you guys saw that this year when I was talking about retail and, like RV manufacturers. Don't forget housing, I discussed quite a bit. Obviously investing in China, etc. So effectively what I'm trying to say is that I was sort of falling outside of just like a tech-loaded portfolio. And so that's why I look at the S&P 500. Now, I'm not saying that like Chinese equities are in the S&P 500 or anything, but I'm just saying that that's kind of why I look at the S&P 500 more than the other indices. But just going back to this, you can see that it tells a story, right? Because the NASDAQ is down 33%. And the reason why the NASDAQ is down 33% is, of course, it's more loaded with tech names. So, of course, it's down more. And then, the Dow Jones Industrial Average, you guys might have to remind me on this one, but I think it's just because it's got a large component of oil names or sort of like resource-based names. And so that's why it's down less than even the S&P or the NASDAQ. But you guys can let me know in the comments why the Dow is as high as it is. And then when you start looking at the assets, what I find is very interesting is that a lot of people last year were saying that, because inflation is running high, you got to get rid of your dollar and buy tech stocks. And I'm not sure why people were making that sort of recommendation. But of course, you could see what happened to the tech stocks. Meanwhile, if you just held cash, yeah, you'd be down on a real basis, but, you're not down 30-40%. And so what's interesting, of course, is, we saw the high flying securities of 2021 really come down in 2022. So Bitcoin's down a lot. The tech securities are down a lot. Now, I didn't cover a lot of the tech names in 2022. I mean, I recently just covered Tesla, and I had covered Shopify privately in our sort of like monthly calls, but I didn't cover that many. I covered Roku and stuff, but you never really saw me super bullish on any of the tech names. And partially the reason why that was is just because I just didn't see a lot of value in those names, especially in 2021 in the first year of this channel. And I knew that was going to cause the channel to grow slower, and that's okay, right? Because at the end of the day, I knew that this was going to reverse. It's not the first time that there was optimism or massive amounts of optimism in technology, and there's going to be other areas where there's going to be massive amounts of optimism. We saw massive amounts of optimism in Bitcoin. That also came down. But historically, we've seen large amounts of optimism in other industries. Like, for example, in Canada, the oil business was very optimistic at one point. The mining industry was very optimistic at one point. Investing in BlackBerry was very optimistic at one point. And, a lot of these things didn't have long-term sustainable stories, or the valuations were just a little bit high, or you're on the wrong end of the cycle, whatever it was. Even like uranium once upon a time was very optimistic. And so, these sort of like bubbles, manias, etc., whatever you want to call them, just over valuations, they will come and they will continue to come. They happen over and over again. The longer that you're investing, you're just going to learn to sort of like spot these things sooner and sooner. And so, I did cover Bitcoin, and just going back to, Bitcoin being down 60%, I know that, if you invested in Bitcoin in like 2013 or 2014 or whatever, you're probably still up. But, the one thing that I wanted to cover, and I covered this in 2021 actually, was I just asked the question to any sort of like Bitcoin expert that I could find. And the question just was as simple as this: how do you value Bitcoin? And I never got a straight answer from anybody, because the truth is you really can't. And so I actually did a 3-part series on Bitcoin, or 4-part series, I can't remember, where I walked through exactly what Bitcoin was, what I felt the utility of it was, and how I would value Bitcoin. Ultimately, I valued Bitcoin as sort of like a store of a speculator's value. And, it wouldn't be a store of value to me. I don't think gold or Bitcoin or anything is really a store of value. Gold could be stated as somewhat of a store of value, but, I just didn't see Bitcoin doing that. But the value to me with Bitcoin really was using it as a way to cut down exchange transactions. Like, if you have US dollars converted into Bitcoin, if you can do it cheaply, and then send it to someone overseas, and then they can convert it back to dollars if they can do it cheaply, And so that's where the real utility was. It was really in foreign exchange transaction, but there wasn't a lot of utility in holding it. Now, I know a lot of people will say that, hey, you just don't understand Bitcoin or the blockchain. No, I absolutely do, but I also understand that the ultimate flaw in Bitcoin was that there was a lot of speculators with the currency. It's something that people started hoarding and holding, hoping that it would increase in value. Really, if you are looking at it as a currency, you don't want it to fluctuate in value materially at all. And so you want the value to stay the same. And, when people were saying that, hey, it's just reflecting the fact that the US dollar was deteriorating, the US dollar was not deteriorating at the rate that Bitcoin was increasing. That was just a flawed argument. And so, I never got into the mania. I never really invested in it, but I researched it heavily, and I spoke to people that were experts in the industry, and ultimately, avoided that sort of like mania as well. And so you can see that, the portfolio largely avoided any sort of like Bitcoin losses. And I would say that there's a lot of retail investors that fell into the tech space and the Bitcoin space bust because, they were buying tech companies where they're either forecasting huge growth rates or insane levels of profitability in the near term, which never really materialized. And, some of these positions might materialize. Like the one that I talked about recently on the channel is Tesla. I mean, those growth rates of 50% growth rates that management is forecasting, they may materialize. Who knows? I'm just not going to forecast it and gamble on what I consider, a miracle in order for me to make a return on the security. However, I would look at Tesla if the share price continued to crash. If it went down to like $25, $50 a share, maybe I'd look at it more. And of course, you guys are well aware of this chart. This is, this is the S&P 500 when the Fed started raising their interest rates. And, they raised rates 7 times this year. And, you can see just what I wrote here, don't ever fight the Fed. And I actually think that there could be more pain on the horizon in 2023 as budgets get scaled back, which of course will bring down revenues of other companies, and then their budgets will continue to get scaled back, and you could really have a deflating of the economy. Now that will be really good for inflation, but it could potentially be more negative news, additional negative sentiment for the stock market. If you look at the amount of stocks that retail investors purchased, they actually were purchasing more in 2022. So is 2023 the year where retail capitulates and they start taking their money out of the security market? If that happens, you could see stocks coming down even more. And of course, if retail is even pulling their money out of like their mutual funds, et cetera, you can see institutional investors start selling off securities too, which could be a big wave of downward pressure. And I've already said in a previous video that I think the market is still slightly overvalued despite the correction that we saw in 2022. And so can the market come down a little bit more? I absolutely think it can. And so, what I'm doing is I'm continuing to focus on downside risk. Despite the fact that I really want to deploy more cash, I'm really only going to be deploying it into things that I think are sure things, like inevitable situations where I'll make money. And the problem is those just don't come every day. And so I have to be very picky with what I buy. And ultimately, the reason why I want to be in the market is because I believe in the economy. And this is a great visualization of that. Notice that, more years than not, well, in a significant manner, the stock market has been up year over year. Some years not so much, some years a considerable amount. And there's only been a few years where the stock market has been down. And, since at least I have started investing, which would probably be around here, this is the 3rd worst year in, at least the last 23 years, you can say. And so, it's a bad year, but that doesn't necessarily mean that 2023 is going to be bad, especially on this perspective, right? Maybe a lot of the risk in the market has come down. I could see it being something like this, down less than 20% in 2023. We'll see how the market sort of plays out. But, ultimately the way I like to think about the securities markets with bull and bear markets is that the bull markets will last long enough for you to think that the bull market will last forever. And I also think that the bear markets will last long enough for you to think that the bull market will never return. And so that's sort of like my thinking as it sort of comes into this. And, I still think that there's a lot of hope for investors where they hope that the security markets will come back in 2023. And I don't know if they actually do. I think 2023 will be another lost year, but that doesn't necessarily mean that there aren't going to be opportunities that come up. And, once again with this, the major point here is this chart is a great visualization of why I believe that you should be dollar cost averaging, especially in a down market. And so, if you are using index funds, just investing in the S&P 500, and you're just following a program of just dollar cost averaging down as it goes up, and, as it goes down, and as the market goes up, you're just buying less because, once again, dollar cost averaging just forces you to buy less as the share price goes up in the market, you're fine, right? Over the long term, over 20, 30 years, you'll be fine. And that's a conversation I had with Strongman Finance. His response to my question of, do you think that the market is expensive right now, was, hey, you know what? Over the long term, it's always a good time to invest in a exchange traded fund of the overall market. And I don't think he's wrong with that. But, what am I doing in 2023? Well, I'm going to be doing a lot more research. So I think I'm going to be less frequent on this channel. I think I might be doing 2 videos a week maybe, and I'm going to be doing a lot more research. So you're probably going to see the people who are on the tracker or the Patreon, you're probably going to see the tracker explode in terms of number of securities, because I just felt like I didn't do enough research. I mean, a lot of models were built and over 100 models were updated in 2022, but I think that I could be doing more research and better research. And so I'll be doing that because, I'm really on a hunt for securities in 2023 because the cash position is just swelling and I do want to deploy some of it. Now, I'll never say that is burning a hole in the pocket, but ultimately I don't want, 90% of my portfolio to be in cash. And what I want to do in this video is I want to talk about how I sort of find opportunities, or at least show you one way that I find opportunities. So what I did was I just ran a screen on Seeking Alpha, and the way I ran it is I just did a forward price to earnings ratio of 15 times, PEG ratio of a maximum of 1.5 times, and a revenue growth rate of at least 22%. There's no rhyme or reason with this screen. I just did a quick screen. You guys can screen whatever you want. I generally like to keep my screens general, and then I'll just go through the names. And so, just based on what I have here, I just want to look at the names. And right off the bat, I saw a name that was familiar to me, LCI, because you guys know that I'm a psychotic person when it comes to RVs. I really love RVs. These guys are a component provider for RV. There's another company that I saw here. I think Generac, they make generators. So you can put one on the side of your house, and if the power ever goes out, you have a generator. But, because LCI came up first, they look like, Wall Street really likes it. It's got it's got an A rating in terms of its valuation. I thought, okay, let's look into this name. And so the first thing I did was I just wanted to remind myself of what they do. So you can see here that they are a more diversified than I thought. I thought they were just an RV parts provider, but you can see that they've diversified. They do bus windows, cargo trailers. They're expanding internationally, they're in marine, etc. So this is good, but ultimately this is all discretionary purchases. So all of this, maybe not railway or whatever, but I would think that the majority of their markets, especially if they're in slide outs and all, stabilizations. For those of you who don't know RVs, this is all premium stuff, these furnitures, the stabilization or leveling units. This is in every pretty much new nice RV. The slide outs are wonderful. These are all expensive parts, and in a down economy where sales are down, people might be foregoing some of these options, right? I don't think they do. I think you need them. They're pretty standard, but ultimately what it means is that the number of RVs being purchased may decline. But the point I'm making is that these are discretionary purchases, and so I would expect these to decline significantly in 2023 and in 2024. And so, as you guys have seen me talk, I talked about some of the marine companies in like the last month or so. You see me forecasting huge declines in 2023 for their sales. And once again, this, just going into their finances, this is just their presentation, slide 22 of their latest presentation. You can see that they absolutely crushed it in terms of sales growth, EBITDA growth, and EPS growth in fiscal year 2022. But once again, the first thing that I'm asking is this a value trap? Because I know RV sales are expected to be in the gutter in 2023. So yeah, this all looks great. You got a arrow going up and to the right. It all looks great, but it screams value trap to me, especially because of what I know about the industry. I know that RV manufacturers cannot sell RVs right now. In fact, I'm on like the mailing list for the local RV manufacturers here where I live, and every day they're just slashing prices just to get stuff out of the lot because, inventory is starting to pile up at least a little bit. They did have inventory problems for a while, but I just don't think that they're able to sell anything right now. And so this is what I mean. So here is an RV industry Association report for the sales in the industry. And so you can see that in November of 2022, all towable RVs are down 53% year over year. So it's in fact a bloodbath in the industry. And you can see that it's across the board. So truck campers are the only ones that are up, which is weird, but it's also the smallest part. I would say travel trailers would probably be the most popular RV. And you can see that, of course, with the numbers as well. They're down 55%. Fifth wheels, I really like fifth wheels, but I just probably wouldn't want to tow one. They're down considerably as well. I didn't realize how few fifth wheels are sold relative to the travel trailers, but I understand why. You would probably want a travel trailer as opposed to a fifth wheel. But anyways, notice it's all down. It's down 25%. So total RV shipments are down 50% year over year in November. And notice that, if you were to just look at financial statement data, well, the first half of the year looked really good. Things didn't really fall off a cliff until the second half of the year. And I think, this second half of the year is a really good indication of where 2023 and potentially even the beginning of 2024 looks like. And so, you have a falling knife here with an RV components manufacturer. But then the question I have for you guys is, obviously, if you have something like a falling knife here, is the pain reflected already in the share price of the company? And can we make a buck here with this type of security? Now, you guys have already seen me do this kind of analysis. When it comes to the home builders, you guys know that the share prices of the home builders have tanked. But as I've been saying for, a little bit of some time now, there are home builders that their share prices have come so low that even if their revenue gets slashed in half, 50% in an industry that has a secular tailwind, even if their revenue gets slashed in half, you're still effectively buying them at under 10 times earnings. And so there are certain companies that are really deep value type opportunities, especially over the long term. And so is this RV parts or pieces manufacturer one of those companies where the share prices come down enough where even if the sales are down by half, would it make sense based on its valuation? That's the question that I would have. And so in order to analyze that, the first thing I do is I just jump on QuickFS because it's a free service for you to get access to multiple years of financial statements pretty easily. And I just look at the EPS. And so notice that this is a $92 per share company. So the first thing I'm looking at is, what does EPS look like? Okay, so you can see that they had a really good 2021 and they're going to end off 2022 with a really high EPS as well. So this is why it showed up on the value indicator. But then the real question is, where do we expect EPS to go backwards to? Does it go back to $5? Does it go back to $8? Because at $90 a share, if EPS is approximately $20 per share. If EPS just comes back to $10 per share because they're only selling half as many RVs, well, you're still effectively buying this company at less than 10 times earnings. In fact, you're buying it at 9 times earnings if they just make $10 per share in 2023. And so this looks like a compelling opportunity. And so here's where I'm going to dive a little bit further into it and see if it's worth buying. And so one shortcut that I'll use right away is I'll go on and take a look at what the analysts are expecting for the next year. So, I said that the earnings, just based on the direction that the sales were going based on the industry data, I said, they're probably going to make around $20 a year this year, just based on their last 12 months revenue forecast. You can see that with a 50% revenue decline, or sort of like an earning or sales decline in the industry, the analysts EPS estimate is kind of right in the ballpark of what I expected. I expected it to be around $10 per share. They're saying that it's around $11 per share. So that's pretty much in line with what I was saying, because I was saying that, the PE ratio would be around 9. And so once again, this becomes a compelling opportunity to further analyze. Now, a lot of people would stop right there and they would say, look, this is an industry that's going through some pain, and the analysts are expecting it to earn $11 in a tough year, 2023. And then, it might come back to $20 later on. And so I'll buy this stock now and hope for the best. But, I always tell you guys, take it the next step. Model out the company, because you guys might find something that might dissuade you from investing in it because you start looking into the nuances of the financial statement. So I'm going to walk through this one with you. But if you're doing this alongside with me right now, I would recommend that you pause the video right now, build out a model, take 20-30 minutes just to build out a model, and then just compare it with what I have and see if you caught what I caught. And so let's dive into that. So let's start with the P&L of LCI Industries. So you can see this is their historical P&L. And you can see since 2012, they've been growing revenue at double digits most years. 2019 was a tough year, but then they really came back. And then, of course, they really grew revenues in 2021. And so, the question I have is that in a higher interest rate environment for a discretionary purchase like an RV, would you expect high rates of growth in revenue in 2023 and beyond? I don't think so. The way I would probably think about it is I'm actually thinking about revenue just declining 20%, but that might be optimistic. Revenue might actually decline by 30, 40, 50% as we saw with the industry data. But, for the purposes of the valuation, just to be a little bit optimistic, I'll probably forecast, just to begin with, around 20 to 25% decline in revenue in 2023, and then maybe like another 10% in 2024, and then 0 thereafter, and then just grow it out at 5%. And let's see what happens with respect to the valuation just by doing that. We can always tweak it afterwards or adjust it, but let's just see what happens just doing that. And so as it comes to building out the model, you can see I'm doing exactly that. So I dug into their financial statements to get an understanding of where 2022 is going to end. So I think it's going to grow out around 17.5%. And then 2023, I've declined at 20%. 2024, I've declined at 10%. Mind you, the analysts do not believe that this is going to happen, but I'm just a little bit more pessimistic. And then 2025, I'm growing at 0%, and then just 5% thereafter. So not a lot of optimism in the tail end of the forecast, but I might be a little bit optimistic with the decline in 2023. This could absolutely decline by more than 20%. It could go down by 50%. So just be careful of my valuation. Also, the net income margins are relatively in line with historical margins. Obviously a little bit lower than 2021, but I think this is a reasonable margin going forward. But, I might be wrong once again with this, but you can see what this is reflecting. Right off the bat, it's reflecting, around in between, 8 and 12 times earnings. The longer you go out, obviously the better it looks, but it is not an expensive opportunity, and there's a lot of room in the back half, the back 6-7 years where they can outperform this 5% growth, and they can also increase their margins from 5% back up to somewhere higher where they were, for example, in 2021. So there is room for upside surprise here. But what does this give us in terms of evaluation? Well, before we go into the valuation, the one thing that I always recommend everyone to do is look at all 3 of their financial statements. Take a look at the income statement, take a look at the cash flow, take a look at that balance sheet. And the one thing that I always look for in the balance sheet is how much debt do they have relative to cash on hand. notice, I understand that they have a lot of inventory. Don't get me wrong. And I'm using a little bit older data here because, they've had 3 quarters. So you'd probably want to look at the newest quarterly data, and we'll look at that afterwards. But notice here that they, at least at the end of 2021, they had a ton of debt, not necessarily a lot of cash. And this inventory, don't necessarily look at the inventory balance as excess capital, because they might have to fire sell some of this inventory just to get it off the balance sheet. So this might actually come off at a lower amount in terms of being able to liquidate it. Or it could just be like parts and materials and stuff that still needs to be cost added to it. So, I'm not going to look at this inventory as excess capital. I'm being very conservative. So, you have a certain amount of debt, which once again has to penalize the valuation. And you can see I'm doing just that here in the valuation. So, from the way that I was forecasting out the business, I got to a valuation of $123 per share. If you compare that to the current share price, you have some upside, right? But you would be wrong in thinking that, it's cheap because they have a ton of debt. Now, we said that they had around $1.2 billion of debt as of the end of 2021. And as of September, they did pay down some of that debt. So it went down from $1.2 billion, I guess, down to $1 billion. And so what that would do is that would bring this negative excess cash amount down just a little bit. But, whether the valuation is $73 or $80, you can see that my valuation that I'm giving this company is lower than the current share price. And so the share price as a percentage of the valuation is somewhere in between, like 115% to 130%. So not a sufficient enough margin of safety for me to be interested in this opportunity. And so here's one of those situations where if you just paused at what the analysts were forecasting earnings to be, but you didn't take into account the debt that they have on their balance sheet, you could be caught in this situation where the ultimate value of the company is a lot lower than what you're projecting it out to be by not taking a look at that debt situation. And why do I penalize the valuation for the debt? Because if I were to buy the whole company, and if I'm thinking about this on a perpetual basis, eventually I have to pay off all that debt with the future cash flows that the business generates. And if I'm going to buy this business tomorrow, the first thing that I'm going to do is I'm going to pay off all that debt, because I don't want that debt risk to remain in the business. The business should be able to operate profitably, of course, without the debt, unless it's sort of like short-term debt as a result of sort of like business cycles as they're sort of like tooling up. But even in those situations, I would require that the debt be paid off right away anyways. And so I'd still penalize the valuation for it. I know some people feel as though a certain amount of debt should be kept on the balance sheet for certain types of businesses. I just don't think consumer discretionary product businesses are that type of business. Now, I actually fully built out that model, and I've included it in the tracker for the Patreons to follow. So if you guys are already a part of the Patreon and you want to build out the model and then compare it line by line to what I have, you can do that by joining us at this lower tier of the Patreon. And effectively all this is you're just buying me a couple of coffees every month to get access to all of the research that I do. And what you can really do is you can compare that LCI model that you built compared to the one that I have, and see if you find something else or if I've missed something or whatever. I'm not perfect. I get things wrong. Now, if you guys didn't see my video recently that I put out on sort of like the 3 biggest losers in 2022 and what I think their value is going forward, which of course are Meta, PayPal, and Match.com, you can actually get access to that video, which I will link right here.